market structure, because even Wyckoff, if you don't understand market structure, then it makes no sense, right? So we are going to actually look at logics behind Wyckoff, right, and see where we can identify them, right, and how they contribute to our trading. So basically I use Wyckoff to identify direction and turning points in the market, right? So if the market is in a downtrend and then the market slows up, then I will be looking for Wyckoff to see if the market is gonna turn at this point. There is not always a Wyckoff, but once you understand structure, as I said, then you can still catch a reversal nevertheless. But if you see a Wyckoff, it's just a plus, right? And also if I have a point of interest, right, then it would actually show a Wyckoff most of the times on a lower time frame before market actually reacts to that point of interest, right? So for example, say the market is in a downtrend, right, but the market wants to reverse. Say this is a higher time frame, right? So the market will start to do stuff like this, right? Test, market push up, push down, push up, push down, creating some sort of consolidation right before the market actually reverse. So Wyckoff basically pushed the market, or the market basically go into a consolidation, and most times when you see a consolidation, there is a Wyckoff present, right? I taught you guys about divergence already, and most time when you see a divergence, it means there is a Wyckoff there, because divergence is also used to tell when market is actually changing trend, right? So this is what I use most of the times to identify Wyckoff, and most of the times I just use divergence because it is way easier, right? Not to be identifying all of the different parts of the Wyckoff and whatever. So that can be in one instance. And another instance where Wyckoff is present is, say you have a point of interest. So say we're looking to sell the market here at this order block, and let's say this is the 15-minute time frame that we're on right now, right? So if market is coming back to your point of interest, something like this, right, in a bull momentum, say on the 3-minute or the 5-minute or the 1-minute time frame, whichever, you're gonna start to see the market slow down like this, right, creating some form of schematic before the market continues to push down. So you can use Wyckoff to actually get your entries at your bigger time frame point of interest, right? And this is how I do most of the time. Instead of you placing your pending order at this order block and risking way more than if you had wait for a Wyckoff, a divergence, or just a simple break of structure on a lower time frame, right? So let's basically get to the point. So in this video we are going to look at the accumulation and re-accumulation schematic. Basically accumulation 1 and 2, because there are two types of accumulation schematic. You have one where there is no spring, as you can see in the diagram right above, one where there is no spring, and one where there is spring. I specifically like the one with the spring because it just gives me more confirmation, right? So then let's look at this example that we have right here. All right, so this is the 15-minute time frame, right? But on the 4-hour time frame, the 4 hour is actually in an uptrend. So this is where I say that if you don't understand structure, then it actually makes no sense, right? Because this on the 4-hour time frame is in an uptrend, and right here, it's basically saying that the 4-hour wants to create a lower high. Notice, all right, so on the 30-minute time frame, there is a point of interest right here. There is a point of interest right here, right? So let's go back to the 15. So there's a point of interest here on the 30-minute time frame. This is the 4-hour. This is a 4-hour trading zone from this high to this low, right? So we're looking for the market to actually come back into discounted price to push up, right? And notice how the market is basically creating these three drives, basically creating divergence right here. So the market is basically slowing up, right? Because we are approaching a POI where we can get a possible reversal to the upside. All right, so when I look at this, let's remove this. When I look at this, first I saw a divergence here, right? So what I did was that I checked if it was valid. So you check by looking at your RSI, and you notice divergence is going down and the RSI is going up. So this means that it could be a possible reversal right here. Now within this last leg right here, I go on a lower time frame. Let's say the 5-minute time frame, right? On the 5-minute time frame, again, what we're seeing is another divergence. And remember, once we say we see a divergence, it means that there is possible a Wyckoff present, right? So this is a divergence right here, and let's look if this divergence is also valid. So right here we can see right here, boom. So this is also a valid divergence on the 5-minute time frame. So we have two confirmations: divergence on the 15, divergence on the 5 minutes, right? Now if you look at this, we see a Wyckoff present. We're gonna go on a lower time frame though. Let's go on a lower time frame so we can actually see the structures more clearly. All right, so this is actually looking at a schematic within a point of interest. So notice how the market slowed down at the point of interest and start to create a divergence, which means that there is schematic. This is what I use to identify my schematic, because I don't be just in the market looking for a schematic, because I understand structure to a level and other aspects of the market. So I don't really look for a schematic. If I see it, then I will use it, but it's not a big deal for me. All right, so if you look here, we have our PS, right? And if you read the document above, you would have known that this is our preliminary support, right? So this is the last support within this little downtrend right here. So after that, you have your selling climax, right? So notice how huge of a move this is. Everybody watching this video should be adults, so everybody should know what the meaning of climax is, right? So when we talk about climax, we say that something is coming to an end, right? So in this case right here, the downtrend is basically coming to an end, right? And how you identify that is that you see the pullbacks right here are getting pullbacks are getting longer, and actually the downtrend are getting smaller, right? So notice here the pullback way up, right? Push down, look at this. So the lower low is basically right here next to this. So and then look at the pullback, huge, and then boom, huge pullback, right? So as I said before, so this is the selling climax, so it means that this is coming to an end. Then we have our automatic rally, right? the automatic rally. So what this is saying is that persons realize that we are at a cheaper price on the higher time frame per se, right? Because remember, we're at a discounted price basically. So we're at a cheaper price point and persons are actually pulling their profits, so the market is basically pulling back, right? So you have persons buying at a cheaper price point and persons that sold are actually getting out of the market, right? So we're gonna have these buys, these bull momentums. All right, so next thing, you notice how the after the automatic rally we have the test, and normally the test a order block or a inefficiency, so it always comes back to test something to push up, right? And then we have the automatic rally, right? So how do we know that basically we want to retrace here or there's a schematic forming? You have what is called a change of character, and all of this right here is what identifies your change of character. Let me highlight that. So this is what identifies your change of character, right? So from your PS to your ST, your secondary test, right? Because the market basically giving you deeper pullbacks, right? Which means that persons are taking profits and buyers are actually coming into the market. So this is a change of character. So when you see this, when market is approaching a point of interest or a cheaper price point in the market, you know that, hey, let's sit this out and actually wait, because there's actually a consolidation coming up. Because majority of the time when this happens, it's getting ready to push the market into a consolidation period, and you don't really want to be trading in a consolidation. So what Wyckoff help you with now is that you get the precise entries outside of the consolidation, because you know when the consolidation is basically coming to an end, right? So this would be phase A, which is the first phase where you have the change of character, right? So within phase B, which is from here, just before your spring, so about somewhere here. So here, so within phase B, you have your UA and your ST, right? So you can have multiple STs here, which is a secondary test. You can have multiple secondary tests. What this is doing, right, within phase B is actually building liquidity, right? Because you have indecision, people buying, people selling, right? And also right here where the market broke structure right here, you have people selling because this induce sellers, right? So a breaker structure induce sellers, because you know retail traders be saying like, market break structure, we're gonna get retest. So market break structure induce sellers, market push back into the range and basically induce buyers, right? Now after all of that liquidity is being built up, right, you have what is known as a spring, right? And this is what I like to see, because when I see the spring, I know that my entry is coming soon. Now if you look at this, the spring basically clear the selling climax and the ST, and if there were multiple STs, it would also clear all of them. So the spring is acting as a sponsor candle, right? So we take our liquidity with the spring, right? So we take our liquidity, so we also induce sellers and take our liquidity from buyers that are buying, right? And then market push to the upside. In this case, sorry, all right, let's look all the way back. So we're going to the 1 minute time frame, which is normally my entry time frame. So looking at this, we have I normally take my entries on the spring, right? I normally take my entries on the spring, but the safest way to take your entries is when the market is actually outside, right? When the market actually breaks out from out of the consolidation zone, which means that it breaks the UA, right? So you'd wait until the market breaks the UA and then give you that retest. But I always take my entries from the spring because that is a safe way. But the schematic is not really complete until phase E, right? Which would be when the market breaks out of the consolidation completely, right? So, which would mean that it's somewhere around here, right? But the spring is another way how to take entries. So normally when the market breaks out the spring, I like to see the spring break structure. I like to see the spring break structure, something like this, and then come back to retest and then push up. But in this case, we noticed this, the spring right here did not break structure immediately, right? So the spring broke structure here, right? So it's basically the test that broke structure, if you want to call it that. But in this case, we'd have two entries because this is an entry also, because the market could easily push past this, take liquidity from that, and then retest this. But we call this a extreme entry, right? So you have the decisional entry and you have the extreme entry. So if you're taking a trade like this and you're risking 1%, what you do is that you set a limit here for 0.5%, which is half, right? And another 0.5 here. So in the event the market should actually break this area, you only lost 0.5. And if it should break this also, you only lost your initial 1%. But if you had your entry here at the extreme, the market would play this and then you would have missed out on that trade. So it's always best if you see 2 point of interest, which is a decisional entry and the extreme entry, you play basically both of them, right? And that is basically it. That is basically how you identify Wyckoff. Note that sometimes Wyckoff, you don't have a spring, so it stops at the ST and then you have your LPS, right? As I said, I'm not gonna be into labeling the chart and everything. It's just to show you the logics behind how Wyckoff works, right? Because it's the diagram and the definitions are already self-explanatory. It's just where to identify Wyckoff, why we use Wyckoff, and all of those stuff, right? So let me show you another example on Euro USD. All right, so I showed you an example where we basically identify a Wyckoff within a point of interest, right? So I am going to show you a Wyckoff where you can actually where it can actually help you to identify the overall direction of the market long term, right? So you know if you should hold a trade for a month, for 2 months, for a year, whatever, right? Now this right here, you have some type of Wyckoff going on right here. So it's some type of accumulation, right? So market was in a downtrend, right? You can see market in a downtrend, and then here the market wants to change direction, right? So there is a Wyckoff present here. So we have the selling climax, we have the secondary test, AR, whatever, break structure, market push down, created a sign of weakness. But you notice here we did not get a spring. All right, so when you see a Wyckoff where you don't have a spring, how do you go about taking entries, right? It's either you're gonna wait until phase E. That's one way how you can take entry. Wait until phase E. You can take a aggressive entry here. So this point of interest right here, you can take an entry based on smaller time frame, not the 4-hour time frame. Or you can wait until the market create a structure here and then break structure, which means that this now confirms that there will be no spring, right? So then you can identify a new point of interest here and take your entry on a smaller time frame within this point of interest, right? and then you could have held this trade because this is a higher time frame, right? So you could have been targeting like maybe 500 pips depending on structure on the higher time frame, right? But we just came out of a downtrend and market basically created schematic to actually turn the market around. Right now, this right here is where most traders would get confused, right? So market starts to consolidate. You don't know if the market is gonna come back down or the market is gonna go up, and this is where reaccumulation comes in. So once I see this, I know that hey, the market is reaccumulating. And again, I won't go through this what all of this means because it's already in the diagram, right? So this is reaccumulation. So the market is basically reaccumulating to actually push to the upside. So when you see this, you know that hey, the market is not going down, so I am going to hold my trade. And then you can actually get re-entries here, right? You can actually get re-entries when the reaccumulation is completed to continue in the uptrend, right? So yeah, all right. So there will be a lot of examples in the gallery of all of the different types of Wyckoff. The Wyckoff without a spring, reaccumulation, accumulation, distribution. There will be a lot of that in the gallery, right? But as I said before, Wyckoff is not it's not something that you need to actually be consistent trading this type of way, right? Structure is really what you need, and identifying how the market moves and price action, right? But this is definitely a good way to basically identify the direction that the market wants to go in and when the market will actually turn. So yeah guys, so that's it for this video, and in the next video we will be talking about distribution, which is basically the opposite of accumulation. Alright guys, see you in the next video.